find your way back home.
What's up, guys? Jay from ESP Profit, and today we're going to go over some consistency tips. Now, these are the tips that I personally use and which will actually help a lot of you beginners and entry-level guys getting to stocks, really how to stay consistent. Really learning a strategy and learning how to take profit from the market really is only going to be 30% of the battle. The other 70% is really keeping your own emotions in check and actually learning to be consistent so you can actually take profit from the market day after day after day. But before I go into everything, this is really just going to be this section right here. I'm just going to do an update, just everything that's been going on for the past month. I mean, shout out to Eric Anderson, biggest profit day trading IDXG. Thanks to ESP Profit for teaching me this game. As you can see, I mean, his net liquidity is almost 6,000 while his profit loss is at $3,000. So it means he started off the actual trade at 92 cents per share with only 2,800 bucks. Now he has 3,000. I mean, just to see a guy that I've been working with time and time again, like every single week, just going over lessons and going over one-on-ones with him. I mean, to see how far he's really progressed now, especially still with a small account, able to pull $3,000. That's more than, I mean, some weeks I end off the week at $3,000. I mean, he made one in one trade. So, I mean, this shows you really like the penny stock market, just not really just me, myself, but just how volatile this market is and how good it actually is to trade in. Looking over Joe. Not a bad trading morning done, 1045, NDXCIX at 14 out of 24. Shout out to my mentor, ESP Profit. And a lot of guys even talk about really, well, staying with penny stocks or lower price stocks. Sometimes these stocks that are actually in a higher price, maybe $14, $15 per share, sometimes 20, they can double, just depending on how volatile the market really is. I know this is really during the shipping boom, so a lot of these shipping stocks went crazy. I mean, DRYS went from $4.50 all the way to $120 per share. So it just shows you that at any price level, these markets can be very, very volatile. Now, just going over a shout out to myself. I mean, one of the biggest plays I've done in the last month was GLBS for 4,200. But the fact is I didn't trade for like 2 days. So I just stayed back, watched everything go really past myself, said I'm going to stick to a specific play that I know how to play. Then whenever GLBS came towards me, I nailed it right on the head. And that's exactly what happens. Sometimes you don't even have to trade. Like, that's really what I'm going to go over in the consistency tips, is some days you really don't even have to trade. You can just sit back and wait for the right trade to come to you, and you can just kill it. And that's really goes all towards, and just for me celebrating how much we've really accomplished, the team and everything itself, I'm going to release a free DVD. So this DVD is really going to go over all my strategies, my setups, psychology, live examples, and just going over just something that I know a lot of beginners can actually digest, and it will actually help them very, very, very efficiently. I know a lot of people sell DVDs out here and there, and they do this. But like, to me, my psychology is just like, if you're making so much money at penny stocks, like in small caps, like, why do you have to sell these overpriced DVDs? So like, just because me, I mean, I've made a good living doing this. Like, I don't really even care about selling a DVD, really. I'll just give it out for free. And if it can help if one person one person actually downloading this DVD and actually going through it and actually is able to pull a profit or even see an increase in their profits or consistency, it's all worth it. So that's basically how I do it. But now we're going to go over the consistency tips of everything that I use to stay consistent in the markets. Now, there are 3 different areas of consistency that I like to focus on. The first one is really finding your niche. Now, finding your niche really is seeing what actually works for you and just keep on doing it, really not varying yourself or throwing a lot of variables in there. So really play the setups that you know you can win at time and time again. What I've really been used to actually playing is a lot of stocks that are very good in the pre-market activity, trending, let's say up 10 to 20%, and right out of the gate, usually some of these stocks have a large influx in price action. So from there, really judging your support and resistance, seeing the entry right before the breakout, then really capitalizing and selling into the spike. I've really done this years and years and years like that. So really, I don't want to really deviate from this plan or deviate from this strategy that I've seen that has worked so well for me. And the thing that adds to it too is really stick with the plan. Don't really play this type of setup, then really want to venture off and do other things. Like, you want to play a different type of setup, or you want to do this, or you want to do options, or you want to do a lot of short selling. A lot of this stuff comes later, but you have to build yourself a solidified ground of how you're able to pull profit from the market, because it's kind of pointless in that trying to discover a whole bunch of different other strategies if you can't even master one. So why try to really tackle on 2 or 3 different strategies? And added to that, try to master, just become the house, really just become the only person that really can do this effectively, or become one of the few that can really do this very, very effectively, because it eliminates a lot of variables out there in the atmosphere. So you're really not worried about, well, can I really make this? I've really never tried this before. I'll just see how it goes. You've seen it happen time and time and time again. So that those variables are kind of out there. So this is really, can this setup actually follow through? If it follows through, you make money. If it doesn't, you can actually cut your losses very, very short if you know how to judge your risk management, which I'm about to talking to in a minute. And usually through that, you can really set up very, very good trades where you either win big or you really don't lose that much. And if you stay disciplined, and discipline really comes with that consistency, and consistency builds on to your discipline, the discipline that you have, and all that wrapped up and together really would keep you really ahead of the curve. And the fact is, I won't bet any money at playing poker. And that's just because I'm unskilled in that aspect. I don't know how to play blackjack, poker, craps, anything like that. Just because to me, that would be a gamble. Since I'm not really skilled in that area, there's so many different variables at play. But on a setup like this, if I'm seeing this, I will trade $40,000 worth of capital in a heartbeat, just because I've seen this setup happen time and time again, and I know I know the odds are in my favor. So that's really what I'm trying to get to, which is usually finding your niche gives you that edge. So you always want to have an edge above everybody else. And trading really boils down to having an edge. If you don't have an edge, you're going to be 50-50 on all your trades, most of the time less than 50-50. So you're really going to be losing a lot of trades. So that's really the whole thing. You really need to find yourself to have an edge. So just look back at your account, look at your previous trades, and see what stocks do you have an edge at? What stocks do you always profit from? And usually those stick with that and just master it. That's really what it boils down to. Now, going over risk management. Now, risk management is really something that keeps you ahead, especially in your account. So even if you lose on trades, you're still able to really win overall in the overall aspect. Now, really, that's just going into trades knowing what you're willing to risk and what your target is. So how I set up most of my trades, especially looking at these early morning patterns, is I want to find some form of resistance that's being set, some form of support, and anticipate the break of resistance. So really some form of breakout to actually happen. Now, usually with my entries, I'm judging off of that support level. So if my entry is 0.46 and the support is 0.36, I have a 10 cents worth of downside potential. Now, with this stock and within this price range and how the stock likes to move, that's a very large downside. So 10 cents worth of downward potential, that's maybe around 18 to 20% really in the stock. So, I mean, this is a very, very, very risky stock to play, just because this is really how the price action likes to go. It likes to either bounce off 48 or bounce off of 36. And since it's priced so low, that the percentages are very, very fast. Now, at the same time, looking at that entry, if I want a 2-to-1 ratio, I'm looking for twice of my downside potential to be my upside potential. So the fact is, if I have 10 cents worth of downside potential, I'm looking for 20 cents worth of upside. So my 0.46 entry, I'm going to look for a target of 0.66. So that's really 20 cents added to the entry of my buy-in price. So with that is usually how this all sets up into is really you're going to, not mistakenly, but you really do this, you're really going to be buying in on the dip and selling into the spike. So it's really not going to be the other way around. You're really not going to wait for the breakout to actually happen, because if you wait for the breakout to happen, that support level is still down to 0.36. So the higher strung your buy-in price is, the more you have to aim for the top. So let's say I got in at 0.56 or so. So that means I have 20 cents worth of downside. So I need to add 40 cents to that, which means I have to really exit at 0.96 or so to keep a 2-to-1. The fact is, the stock, it spiked at 0.79 and it came right back down to in the 0.5s. So it kind of came right back down to your buy-in price, which means you're gonna have to hold through a lot of this volatility. Even though the stock kind of it went back up to where you would actually have to sell it at, you have to really hold through so much volatility. So that's why really the entries are very, very, very key into these stocks, and that really builds into the risk management. Now, how rich risk management is very, very key is, let's say if you use a 2-to-1 ratio for your stock, some people use 3-to-1, some people use 4-to-1, just really depends on your entries for that stock. You can vary them up. So if I have a very good entry to a stock, I can aim for 3 times of my downside for my upside. So it just really depends on where do you get into the stock. Now, what risk reward management really helps you for is that, let's say every single time you win a trade, you win 1,000, and every single time you lose a trade, and since you actually base it off of that support and half of that, you're only gonna lose maybe around 400 to 500. So every single time you win 1,000. Every time you lose max 500. At the end of every 2 trades, you will always net 500. So let's say you're only profitable 50% of the time, you will always stay ahead. So you will always net $500 at the end of every single 2 trades. So it's kind of like cheating. So even if your strategy, or not really your strategy, but really if you're not as consistent enough to really nail trades more than 50% of the time, if you keep a nice risk reward ratio, or you keep your risk reward in check, you will always net a profit at the end of 2 trades, or at the end of 3 trades or so. If you use, like, let's say a 3-to-1 ratio. So that's really how it works. So it's a good edge you can give yourself. So even as you're learning, you're still able to pull a profit, rather than really just seeing your account just slowly diminish like that. And then most of the time, a lot of people's accounts diminish is because they hold on to losers way too long and don't hold on to the winners. If you really reverse that, if you was to hold on to your winners very, very long and not hold on to your losers, which I see some of my students and people that I teach, what they're actually starting to do now is really switch that around. And I've seen tremendous results. I've seen guys, like, they'll cut their losses at $30, let's say a downside. Let's say right when their account is down $30, they'll jump out. But on the upside, they'll hold on to those winners and make 150. And that's with a small account. So with a small account, just doing that, imagine if you apply that to a larger account, or as you build it up. Just think about that. So I mean, that's really what it all boils down to. This is really that antithesis of risk management. Now, and the other aspect too is really self-control. Now, with self-control, really a big factor in that is just the fear of missing out. So, like, if you ever hear of FOMO, or fear of missing out, that's really just watching a stock just do radical numbers and just not getting in, and just waiting and just like, oh, I want to get in, I want to try to make some form of profit. Let's do it. I don't care. Let's just jump in there and see what can happen. So that basically completely throws out your support, your entry, your resistance, your target sell price, all that. You throw all that out the window just so you can get into a trade, which most of the time means you're going to end up selling for a loss. Just because, as you can see, as the stock ramped up, broke past the resistance, kept on going up into the spike to the spike. If you see these green candles, that means there's buyers there. So the fact is, people are buying up at 0.68. 0.68 and a downside to support is 0.36. Really, with that risk reward, that's pretty crazy. And then the fact is that there's people that buy and sell like that basically on instinct, nothing really planned, no type of due diligence happening. So these are actually buyers up here buying at such a high price. Now, the fact is, if you have that fear of missing out and you just want to jump into a trade as bad as possible, the fact is, inevitable, there will always be some form of pullback, especially as the spike starts to increase and the higher the spike goes. There will be some form of pullback and you will get caught through there. Now, can you profit from these spikes and buying and selling into the spikes? Yeah, I mean, if you can see, if you was to hold through this and your account being down like 20% after this big dip, if you somehow you can hold to that, which I wouldn't, because if right when I'm down 5%, I'm out. I'm jumping ship and I'm planning either another entry or just letting the stock go, and I just didn't trade it right. And that's my discipline, how I use myself. Now, the fact is, if you're not disciplined, you're gonna hold through a negative 20 drop. But the fact is, the stock can rear up with a lot of height, a lot of influx and volume, and it can really spike to new highs. So you can still take a profit, but this is one of the most riskiest profits you can actually take. So the fact is, really having that fear of missing out, just wanting to get into every single trade that starts to go up, will really overall, after let's say 10 trades or so, you will sell for a loss. I mean, you will have to settle for a loss in any form of a larger time frame. It may work one day, but I'm talking about usually weeks and months. Doing this, it will never pan out. It will never pan out. If it did, people wouldn't really set up support, resistance in this. Everybody will just buy spikes. So the fact that everybody doesn't buy spikes, especially now that are actually profitable, there's a reason for that. So you really have to think like that. Now, sitting back and waiting for what you know will actually work, and it will actually save you from these very cringy and just account destroying losses. So if you really see, like back in when I started, I mean, with a $2,000 account, I would take $700 losses, which is I'm not good at math. That's what, 40% or so. So I mean, $700 loss on a 2,000 account. So you have $2,000 and you go down to 1,300. That's ridiculous. But the fact is, you have this fear of missing out. You see a stock doing numbers. I think it was a stock that it ran just like IDXG. It went from like 0.5 all the way to $1 per share. And I was like, whoa, it's kind of high strung at $1 per share, but what if it can go from $1 to $2? It can go right when I bought in, the stock went from like $1 per share, like all the way down to like, I think it was like 0.7 or 0.6 something. I mean, it was a very fast downtrend. I just kept on telling myself, yeah, it's gonna rear back up and it's gonna go again, and just kept on going down, holding on to those losers like that. Ooh, it just destroys it. And that's the fact is, you have to be very disciplined in the setup. Now, buying and selling the spike is the riskiest thing you can do, because usually right after that, the tip of that spike will be the hard pullback. If people don't see the stock actually continuing, they're going to dump their shares. There's people still holding shares from 0.39, 0.4, buying tens of thousands of shares, and this big run up. Just imagine from your buy-in is 0.38. Now the stock is at 0.73, almost 0.76. That's almost double the price. So the fact that since it's almost double the price, if you're up 100%, I would dump. So that's going to be the psychology for them is, well, since I'm up 100%, it doesn't feel like it's going to go anymore. I'm going to dump. So everybody starts dumping at once, and you're going to get caught on the bad side of the stick. And that's usually what happens. And also, don't boredom trade. So if, let's say during this day, just a lot of stocks aren't moving, you look at the pre-market scans. Pre-market scans really aren't moving that much. A lot of stocks aren't trending and setting up correctly. Don't just say, well, what the heck? Let me just trade. Let me just see what happens. Let me see if I can pull a profit on this stock. Sit back and just let the stock market do its thing. Let it give you setups that actually do well, and that you actually know how to pull a profit from. And see, when you boredom trade, it just adds unnecessary losses. So losing $200 here may not sound that bad. Let's say if you're up, let's say you're up 1,000 on the week, and you just lose $200 on a little boredom trade. But if you boredom trade every single week, after a month, I mean, you lost 1,200. And that's the whole thing. It's just time after time, just boredom trading like that. You can really see, you can almost account for it. You'll lose a lot of money in the long term. Or sometimes you can really, those boredom trades can just be the edge that you really need to throw out so you can actually start to be profitable. Let's say you always break even after those boredom trades. If you eliminate those boredom trades, you can actually start to be profitable in your account. So sometimes those can actually be the make or break for your account. But overall, these three different things really just to look for, just finding your niche, risk management, and self-control. All three of those wrapped into one. Just learning consistency. All those wrapped together, you will see a difference in your trading. I can guarantee it. Now, with consistency and how it really matches up to strategies and how important it is, consistency is up there. But I would say 70% of the battle of trading is consistency, because anybody can get lucky with a nice trade. Let's say, I mean, I'm not saying like one of my students, Eric Anderson, was lucky. I mean, he played a nice trade, and that the stock just gives you a lot, especially if you know how to trade it right. But the fact is, let's say he made $3,000 right now, but let's say over the next couple of days, let's say he just starts to make a lot of risky plays, using a lot of FOMO, not really judging his support and resistance, not doing a lot of risk management, and he's really staying outside of his niche. You can destroy that $3,000 gain in no time at all. And that's exactly how it goes in the stock market. The stock market doesn't wait for anybody. It doesn't care about anyone. It's no respecter of persons. If you come outside of your strategies, come outside of what you've been taught and what you've seen works, and you want to go test something else, it's all a gamble after that. So you really have to really imprint that into your brain, that anything that you've seen that hasn't been proven to work is a gamble. So that's really how it goes. Overall, just I'm gonna have all these areas of consistency, self-control, risk management, finding your niche, all those 3 different topics. I have it written down in a notepad format. I'm going to link it into the description where you can download it. So even while you're trading, you're able just to watch it and look at those tips and see if your tips are actually lining up with what I'm doing. So if you can actually have that, let's say if you have 2 different screens, on one screen have those tips, another screen have your broker, and as you're trading, see if everything is lining up. If it isn't lining up with everything on there, it's not a good trade. And that's how it really has to go. Trading has to have its rules. If it's lawless, if it's a lawless society with how you trade, you will lose in the long run. So you have to build yourself some form of rules of consistency. And overall, that's really how it's going to go. So this is Jay from Eat Sleep Profit. Hope you guys like this free video stuff. If you like it, hit a like and comment. I mean, I do this for free. So, I mean, if you want more videos like this, I'll jump on them. Just say the word. Just in the comments, give me some video ideas. What different type of topics of trading you want to go over. So just ask and you will receive. So this is Jay from Eat Sleep Profit signing off.